Okay, in today's interview, we are talking to one of the most interesting people to discuss macroeconomics, to talk about the future of the financial system, precious metals, all types of very interesting subjects with what I think is one of the best researchers out there to discuss inflation, macroeconomics, and that's Lyn Alden. So for everyone listening, please make sure that you hit the like button on the right side, the left side. Let's send this out to more and more people. Comment down below, Lyn rules, if you're excited for this video. In the description right there down below, we'll have a link to her website, her Twitter, everything like that. And then I just want to do a shout out to our sponsor for today's episode, which is First Majestic Silver. First Majestic Silver is one of my favorite silver mining companies. They have about a 70% of all their revenue is from silver, so a pure play silver company. The CEO, Keith Neumeyer, is one of my favorite CEOs and a guy that withheld a lot of ounces of silver when we had the price crash in silver earlier in the spring of 2020 because he just thought it wasn't fair and he waited until the price rose. So really awesome guy, really awesome company. So that's First Majestic Silver to check out to add to your portfolio. So thanks, Lyn.
Hey, thanks for having me. Glad to be here.
Okay, so one question that I wanted to ask you, right? So there's a lot of discussion about no one really knows what's going to happen. Like it's a really weird territory that we're in. Some people are saying we're going to have another crash and deflation. You know, other people are saying they're going to print a bunch of money. So my first question to you is, how do you see 2021 playing out here in the broader sense of the financial system and as it pertains to our investments and the future of really the global monetary system?
Yeah, so it's partially going to depend on a couple big variables. And so I've been calling this a macro heavy environment. And so what that means is that, in most times, most decades, investing is a lot about the micro. It's about focusing on individual companies and things like that. And unfortunately, this is a very macro heavy environment. And so there are giant variables outside of any individual company that make a big difference for that company. And that's things like fiscal, stimulus or budget deficits and things like, what is the Fed going to do? And so those, I think, are the biggest variables to watch in 2021. And so the biggest one I would start with is what kind of aid packages is Congress going to pass? And so I think that's one of the biggest things to watch because that's going to have a large impact on the inflation versus disinflation side. And so if you were to, because basically the economy is so damaged at this point, right? We have 10 million people, fewer people employed than they were last year, even after you've had a partial recovery. And overall, there's just a relatively weak economy still. And so if you were to not get fiscal aid, and that's again, right or wrong, people can debate whether or not we should or not, but just looking at the numbers, if we don't get aid, then we're probably looking at more kind of a return to like disinflation, kind of a, like a sideways inflation performance. And we'd have relatively weak growth. You probably wouldn't want to be heavily in say, cyclical or economically sensitive stocks, things like that. On the other hand, if we get more and more fiscal spending, which, statistically speaking, we're probably going to get, given that, the president and one side of Congress have a kind of a slim majority there, we're probably going to get further aid packages. And, so that'd be fairly good for some of those cyclical stocks and for households, but it also has the high probability of being inflationary. And so if you look back over the past year, we've had 25% broad money supply increase in just 1 year. And that's likely set to continue. I think about 10% would be the minimum, and it's looking probably more like 15% or higher broad money supply increases here in 2021. And so if all of that comes to pass, I think we can expect higher bond yields and most likely some higher inflation. And so then the key things to watch is the Fed going to step aside and keep their current rate of treasury purchases, or are they going to be forced to buy more treasuries? And I think that's kind of the biggest set of variables to watch as this year progresses.
So if you're a betting woman, are you betting on them stepping in and passing a lot of these stimulus and the Fed getting really involved and the government printing to high heaven, or are you on the side of less is going to be done if you're a betting person?
My base case is to see a significant size of aid packages I don't think it'll be as large as some people expect, but I think it'll be really large. And then I think that the Fed, they're currently purchasing about 80 billion in treasuries a month, and so analyzed over the course of a year, that's somewhere in the ballpark of a trillion, and that's going to, and whether or not that number ends up being quote unquote sufficient is largely going to depend on what size those fiscal packages are. And so we went into this crisis running deficits that were over $1 trillion a year in an economic expansion. And then last year, of course, it was several trillions of dollars because we did like $3 trillion of aid on top of that $1 trillion base deficit, and tax revenues went down all in the same year. And so this year, we're still going to have impaired tax revenue. We still have this structural demographics entitlement-driven deficit. And then on top of that, the big question is how much aid. And so I do think that we're going to get more aid, and then how big that is will in some way dictate whether or not the Fed has to step in. And if they don't, we're likely to see higher treasury yields, which should be good for some like value-oriented stocks, like things like bank stocks, things that kind of benefit from higher inflation or higher or steeper yield curve. Whereas it could put some pressure on some of the growth stocks, like say Apple or Amazon, or especially some of the unprofitable, really kind of high-flying tech stocks. That's where you can see some pressure on those in a similar way that we saw actually in late 2018 when the Federal Reserve was doing quantitative tightening and yields got up to about 3.25%, which is still historically low, but in that time period with so much debt in the system, that started to break things. And so those are the kind of things I'm watching. My base case would be higher inflation and higher deficits.
Yeah, I was laughing when you were talking because it's just like if you just look at it from a purely common sense perspective, and you said the Fed's buying 80 billion, and it's just like it's so amazing that it's even occurring, and everything's still relatively functioning. But one of the things that a lot of my guests have talked about is the necessity to keep those rates from rising because of the problems with debt, and thus some form, stepping in and having yield control. What do you think? Do you think that they would allow rates to rise?
So I think the end game scenario here does involve yield curve control. But the big question is what level do yields have to reach before they would have to step in and do yield curve control? And in some ways, the market will dictate that, because if the Fed just kind of keeps their current rate of purchasing, yields will probably continue to rise, assuming, again, stimulus happens. But yields will continue to rise until something breaks. And so we saw that happen in Q4 2018. And we also saw it just before Q4 2019. We had this kind of pattern of the Fed just does their thing until something breaks, and then the market says otherwise, and the Fed just says, we're kidding, we're going to dial back all of our plans. And so, if you look back over the past century, there have been two inflationary decades in the United States. Those have been the 1940s and the 1970s. In the 1940s, it was due to very large fiscal deficits, not unlike now in many ways. So a lot of my work has shown that, in terms of monetary and fiscal policy, the 2010s looked a lot like the 1930s, and the 2020s are shaping up to look a lot like the 1940s. And so basically, that was the only other environment where we were running the deficits that were this big as a percentage of GDP, and the central bank was buying a lot of the treasuries to pay for those fiscal deficits. And because federal debt to GDP got above 100% in the 1940s, they couldn't let yields rise, even though there was inflation. And so what the Federal Reserve did was they said, okay, we're not going to let yields go above 2.5% on the entire kind of duration of the yield curve. And so they basically were willing to print money and buy treasuries as needed to maintain that yield, even though inflation spiked in the double digits. And that was a different scenario than the 1970s, because the 1970s inflationary period, we actually had pretty low debt to GDP, both in the government sector, the household sector, and all corporate sector. All those different places had pretty low debt. So when we got high inflation, Volcker was able to raise interest rates and basically quell that inflation. Whereas I think that because there's so much debt in the system, that if you were to get treasury yields that are 3, 4, 5%, and you look at how much debt the government has, and if you do math on what those interest payments would be by the federal government, that basically renders things acutely insolvent. And so it looks a lot more like the 1940s, where they pretty much have to keep yields below the prevailing inflation rate, likely for several years.
Acutely insolvent. That's really nice. That's a really nice way to put it. So let me ask you, can you have inflation without money velocity? This is a subject that a lot of people are discussing, right? I've had Jim Rickards on, and Jim says, basically he says people are dumb if they think inflation's going to happen, because that's not how it works, and it has to do with purely money velocity. And I've had other people that have come on and they've said that that's nonsense and Jim's wrong, and we're going to get inflation and you're already seeing it. I read an article by the head commodities researcher for Goldman Sachs, and he said they're starting to call corn Bitcoin because the commodities are starting to, really take off. And obviously we've seen that. So can you elaborate a little bit on, is it possible to have this type of inflation you're discussing without money velocity? A lot of people have said, well, money velocity is down because, people are psychologically scarred and been locked in their house and such. So can you touch on that?
The answer is actually somewhere in the middle. Like most things in life, usually the kind of a black and white view is not really ends up being the fully correct view. There's usually nuance. And so, my research shows that if you look back over history, if you do kind of a study of velocity, you do a study of inflation, you find a couple things. One is that velocity doesn't have to rise in order for inflation to happen. It just has to stop falling. And so, for example, if you look at the 1970s, that velocity was lower than it was in the 50s. You didn't have a ton of velocity in the 70s. Now, it was higher than today, but it was lower than the periods right before it. And so the thing that correlates the most with inflation is an increase in the broad money supply. And so that's not the Federal Reserve balance sheet. That's the broad money supply. So that includes currency in circulation. That includes checking accounts, savings accounts, things like that. Now, the Federal Reserve increasing their balance sheet is one of the variables that can lead to broad money supply increases, but it doesn't do it alone. And so when we have a sharp increase in broad money supply, then, by some definitions of inflation, that is inflation, right? So that's the increase in the amount of currency in circulation and the total amount of different types of ways to measure money. Now, then the big question is, where does that money go? If velocity is relatively low, it tends to be in financial assets. And so it boosts up the valuations of equities and real estate and bonds and things like that. On the other hand, if you get more velocity and if you get scarcity in some sort of commodities, that's when you tend to get consumer price inflation. So we saw that in the 1940s and the 1970s, where you saw an increase in broad money supply combined with some commodity shortages, and that's when you had just outright broad consumer price inflation. And so, overall, what we'd have to see in order to see inflation is mainly kind of two things. One is the velocity wouldn't have to go up a ton. It would just have to stop falling while broad money supply is still increasing substantially. So that's kind of the first thing. It just has to stabilize and stop collapsing, which is actually in some cases started to see a little bit. Second, you'd have to really see kind of a scarcity in some commodities. And as you pointed out, we're starting to see that in some food commodities, especially. The big one that we really haven't seen that too much yet is energy, because there's been this big period of oversupply, mostly unprofitable supply. But that's kind of the key variable to watch, because one way to think of it is that when the broad money supply increases substantially, it goes to whatever is scarce. And so if commodities happen to be abundant, let's say you just had a big commodity cycle, you have a period of oversupply, then commodities are not going to be scarce, and there's not going to be really much tightness with commodities. And so, there's still kind of that deflationary pressure. Whereas things like, beachfront property, fine art, gold, silver, Bitcoin, high quality stocks, those are the things that are scarce, and that's what money's going to pour into. But on the other hand, once we get that commodity shortfall, which I think there's good reason to believe that could happen later in 2021 or into the next couple of years, that's when you're more prone to get consumer price inflation in the very broad sense.
Interesting. Yeah, you took a couple of my questions away from me, which was, number one was, is velocity still falling? And number two is, how does the supply chain mess ups that have happened this year, how does that affect it? Because that's been pretty interesting. I mean, it seems kind of like a perfect storm. And when I ask you inflation, I guess what I'm discussing is the one where you're at, where your neighbor knows about it, where your neighbor is starting to recognize it. Because of course we've had this type of financial asset inflation for quite a while. So when you say your base case is higher inflation, are you saying inflation in types of everyday goods that affect, that especially affect, your your average citizen, your average middle class citizen that has a fixed income?
Yeah, so we've already had asset price inflation, and that's the big question next is if we're going to get that broader kind of normal type inflation. And due to supply limitations, we've already started to see that pop up in certain areas. Like lumber is at multi-decade highs pretty much. Many commodities are extraordinarily highly priced. So, for example, if you look at beef, it's like double the price it was 2 years ago, and it was already at all-time highs 2 years ago. It wasn't like some big dip. And so, basically, if you look at beef, it looks like a Bitcoin chart. And so, we're already seeing kind of targeted broad inflation. If you look at, for example, shipping rates, we've had a kind of a restriction in container ships. And so if you look at the cost that it takes to ship a container from China to Europe or China to California, those rates have gone up. Again, that looks like a Bitcoin chart this year. It's up like 4x or something like that. And the big thing that's still holding down inflation is energy prices, because energy prices are still very historically reasonable. I mean, they're cheaper than they were 15 years ago, for example. And so I think the biggest thing to watch is what happens some of these really broad things. So we're already starting to feel it in consumer price inflation. We're already starting to see the treasury market is starting to price in a little bit more inflation. And I think we're on the early stages of an uptick in inflation. But the key things to watch will be what happens with some of the really big commodities, like especially oil and gas, and then to some extent things like copper. What's going to keep happening with lumber supply? And once you start to see those kind of things trickle up, that's when you get the pretty broad inflation.
Got it. And that's what seems like it's beginning to, or has begun in motion. I mean, copper's made quite the move. So let me ask you, what do you think it looks like? What does the next few years look like? I mean, there's a camp that essentially thinks that, we're headed towards more of a hyperinflationary scenario where there is a loss of confidence in basically in fiat currencies, and this present system of fiat currency can't exist much longer. And then, there's another crowd that just to say maybe we'll have 5% type of inflation situation and then we'll get over it. What do you think the future looks like?
So my base case throughout the decade is that real yields are going to be negative. And so whatever inflation happens to be, it could be, let's say, officially measured, 3%, 4%, 5%. I think that treasury yields are going to be below the inflation rate. And so regardless of what the inflation rate ends up being, cash and sovereign bonds are likely to lose purchasing power over that period. Now, some of the scenarios that can result in a much sharper period of inflation would be, again, if you were to get a severe energy shortfall, for example, like a variety of things could lead to that. Like, for example, if you look at the amount of money being spent on oil and gas production, exploration and development over the past, couple of years, that's a much lower figure per year than it was, 5, 6, 7, 8 years ago. And that, it's partially a good thing because we've had this period of oversupply. You've had a lot of kind of capital destruction in the industry, just people drilling in ways that weren't profitable for their business. And so they weren't free cash flow positive. They were very just kind of destroying shareholder capital. But the commodity cycles tend to go in these boom bust characteristics. So you go from a period of oversupply and reckless drilling, and then, that basically blows up so bad that people, they stop drilling, and then there's a shortfall. And it's like, if things reopen, if India oil consumption keeps increasing for China and India and some of those other kind of large developing countries, you can get into a situation where oil is actually pretty tight, and that's where you can potentially get some pretty high inflation spikes. And it's going to be particularly interesting because unlike the 70s, they're not really going to be able to contain them too much because of the budget deficits that are so large. It's going to look more like the 1940s, I think. And so my base case isn't for hyperinflation, but it is for a prolonged period of some degree of inflation and negative real yields.
So how does this whole thing end? Like, what does the end game look like? I mean, you and I were talking before air, and I said, "What are you doing this weekend?" You said, "I'm going to work." You're a researcher. You're spending so much time really dissecting what's taking place. And I wonder, what do you think this looks like? How does it end here? I mean, does this just go on indefinitely and budgets continue to get bigger and bigger? And then, when you and I have, total gray hair one day, the United States budget is like, the debt is $9 quadrillion or some number like that, and this just keeps going? Or how does this play out?
So I think that, a couple ways to look at it is as a percentage of GDP and kind of keep things in ratio. And so I do think for the next several years, federal debt to GDP is going to increase. And then the big question is what happens after that. And so, for example, if you look back at the 1940s, people could ask themselves, how is this going to end? Because the 1930s had this big period of private deleveraging, and then you had this big federal debt bubble in the 1940s. And basically, the way that they fixed it was, they devalued the currency very considerably in the 1940s because you were running inflation rates that were much higher than the treasury yields. And through yield curve control, you basically devalued the currency. And in some ways, that devalued the debt. And so anyone that was holding treasures or cash, got impaired. They lost about a third of their purchasing power. And so ironically, debt to GDP actually was contained and started to go down, not necessarily because, all that money was paid back. It was actually just because, they inflated a big chunk of it away. Now, back then, ultimately, that ended up being rather productive because after the war, they were able to repurpose a lot of the manufacturing they had built up, and they were able to kind of do this turn towards austerity. So they devalued a lot of the debt, basically inflated their way out of it. But then instead of just keeping that going into, say, a hyperinflation, they turned towards austerity and had a really good outcome. Now, it's a lot trickier this time because we have more of a demographics issue. Back then the United States was running current account surpluses. Now we're running current account deficits. And so my base case over the 2020s would be to see, a pretty significant period of inflation, perhaps similar to the 1970s, where, you kind of start getting some scarcity in some of these commodities, and, eventual shift, probably due to demographics and other things like that, where eventually they rein in the budget problems, but not until they basically inflated a big chunk of that debt away. And then basically after that, kind of regain control of yields. And there's some opportunities there for people that are invested in, say, commodities, invested in precious metals, invested in foreign equities, for countries that might be able to come out of this a little bit better. That some countries are in better fiscal shape, and so that's kind of how I'm seeing it play out.
So I'd love to ask you. I want to get onto that subject of all your research and preparation. You talked about commodities, metals. You talk a lot about Bitcoin, you talked about foreign assets. So I'd love to discuss that. But real quickly, you said when you were talking, eventually I think they're going to be able to rein in the budgets. Like how does that look like? Because I hear that and I'm like, that sounds like a foreign language. I mean, what do they do to even make that occur?
Well, there's a couple things, and none of them are easy, which is why they probably won't happen for several years. But for example, if you look at how different countries manage their budgets, one of the reasons the United States has one of the largest fiscal deficits is really there's two giant variables that contribute to that. One is that we spend a larger percentage of our GDP on military than many other countries. And in some ways, they've actually kind of benefited from our military spending. And so some countries have not really felt a need to build up the military because we basically provide that protection for them. And I think over the time, that's probably going to have to rebalance a little bit where they kick up their own military spending. The United States, basically pulls back and focuses a little bit more domestically. I think their, kind of necessity is going to enforce that. A second thing is that the United States spends about twice as much per capita on healthcare than any other developed country. And so, if you look at our numbers, we spend something like 11,000 or 12,000 per year. Whereas if you look at, say, Japan, even though their population's older, they pay something like 5,000 a year.
Are you saying the government does or individuals do?
Total, basically combined.
Got it.
And there's a variety of reasons for that. Because if you look at who pays for it, that's always different in different countries. So some markets are more paid by the individual, other ones are more paid by the government. It's always really a blend of both in developed countries. And for the United States, when you look at the total amount together, we're far more expensive per capita. And again, one of the things that happens is that basically a lot of drug makers and kind of medical device makers, their margins in many cases come from the United States because they'll make the same product, like let's say a pill, and it'll be 3 times more expensive in the United States than it is in, say, New Zealand. And that's kind of the business model that a lot of these have had. And in some ways, due to kind of money in politics, we've actually kind of encoded that into law. We've actually restricted our ability to, for some insurance companies or for even Medicare and things like that to negotiate and get those prices lower. And so, for a variety of reasons, that's kind of an area for us that has been kind of a sticking point. And so I think they're going to have to make some hard choices probably when these limitations start to come back at us. For now, there's not a ton of consequences because the more they print, it doesn't really cause say the price of oil to go up, and so people don't feel it as much. But that really becomes a limiting factor when you start to get actual commodity inflation.
Interesting. Yes, so maybe the politicians might have to give up their second homes and lose a little bit more money in politics in that situation. So let me ask you, we talk a lot about precious metals also on this channel as well, which for, many investors, especially people that are newer to the sector, the last, 6 months or so has been rough on them. We had a little fireworks for a few days in silver, but then that settled back off. What is your forecast and your expectations for gold, silver, and related equities? And how would you assess the market now? The lackluster performance that makes people say, well, every single tailwind should be at its back right now, but still nothing's happening. So what's your assessment on it?
So I'm pretty neutral for about 6 months, and I still remain long-term bullish. And the key variable to watch is actually real yields. And so if you look at gold compared to the 10-year Treasury minus the prevailing inflation rate, and that's people can debate about what the real inflation rate is, but because gold is largely financialized, it tends to follow the 10-year Treasury minus the official CPI. Or you can use the Treasury break-even rate. So it's what the TIPS market is pricing in as their inflation expectations. And so if you track gold next to real yields, it actually aligns inversely very closely. And so gold's actually doing what I'd expect it to do during this period when real yields are kind of chopping along sideways. And so what we saw from during that big gold bull market from mid 2018 all the way up to mid 2020. You saw real yields collapse. And so real yields went from like positive 1%, and they fell all the way down to like negative 1.08%, but based on that measure. And then from there, because the 10-year Treasury started rising, so the 10-year nominal yield started rising, roughly, a little bit faster than the official inflation rate, you actually started to get kind of a, no longer deterioration on the negative real yields part. So they went up to like, negative 0.7, which is funny because it's still negative, but it's higher than its rate of change. So it's higher than it was at negative 1.08%. And then, of course, it's tended back down again. So it's kind of been bouncing around that negative 1% area. And I think until it kind of breaks below that, it's hard to get kind of a really good move on gold and silver because, rate of change terms is not getting worse. The big question I think to watch out for is to go back to some of the things we talked about earlier, which is the yield curve control. Because as long as you get an environment where inflation's rising and yields are rising to compensate for that, then that kind of keeps gold in check. The scenario where gold totally explodes is if you get, say, yield curve control, or just for whatever reason, treasury yields stop keeping up with that inflation, and then you push back, well below negative 1% real yields. That's when gold can explode upwards. And if you look back, for example, the 1970s, if you look at the chart of real yields versus gold, the big spikes that gold had during that period were during the big negative drawdowns in real yields. And so real yields hit as low as negative 4% in that decade because there were periods where the treasury market just was not keeping up with the inflation rate. And so that's what I'd watch. I'd watch real yields, and specifically the 10-year yield minus the 10-year break-evens if that were to break below negative 1.08% and then keep going south.
Interesting. So what would need to occur for it to break south? Is that yield control, or does something else make that happen?
Yield curve control would definitely do that. And the other snare would just be that, soft yield curve control. So the Fed's buying a lot of treasuries. The treasury market just doesn't keep going higher. And then you get an inflation spike and the treasury market doesn't keep up. And then that'd be kind of like the 70s snare, because there was no yield curve control in the 70s, and yet you still had those spikes to negative real yields. So either of those two options can occur in order to get a big blow off top and a big kind of sharp, upwards valuation in gold and silver.
So you said a little bit ago you're kind of neutral for the next 6 months or so. Are you anticipating them then in 2021 implementing some type of either hard or soft yield control?
So I think, in many ways, they've already been doing soft yield curve control, which is why we're at negative 1% or so. And so the fact that the Federal Reserve has been the biggest buyer of treasuries in many ways makes them kind of doing de facto yield curve control. And if you look at different measures like where the 10-year yield should be at this point, if you look at, for example, compared to the, it historically follows the copper to gold ratio pretty closely, or I mean, normally the 10-year treasury is higher than the inflation rate. And so this has actually been a pretty usual period where it's actually very low. It's at negative 1%, the real yield. And so they're already doing soft yield curve control. The question is whether or not they'll be able to keep doing that while you get an inflation spike. And so, whether or not they do it formally or it just kind of happens kind of more organically, those are the environments that would be very, very good for, commodities in general, but especially the monetary type.
So when you say that you're neutral for the next 6 months, is that specifically on metals or is that on commodities as a whole?
That'd be specifically on the monetary metals because commodities. So the one difference there is that commodities will tend to track inflation period. And so if you get higher inflation, that should be good for things like copper, oil, silver to some extent. Silver can hold up a little bit better in that environment. It's a little bit of a mix of industrial and monetary. So higher broad inflation should be good for commodities broadly. Of course, unless there's one commodity in particular that has some sort of oversupply or something. But in a broad sense, that should be good for commodities. Now, gold in particular, being a more monetary asset, it's more like it's more like a currency, and so that's the one that's more tied to real yield specifically. And so in that scenario, it doesn't necessarily do well in higher inflation unless real yields go down. And so that's the one to watch out for gold.
Interesting. Yeah, we talk a lot about I have a lot of people that come on. We talk about uranium and some other commodities. So I was curious your thoughts on that. Now, let me ask you, where do you stand on Bitcoin right now? I know you've been bullish on it since, I don't know, March, April or so when we had the big move downwards. What's your views on that and the broader crypto market in 2021?
Yeah, I've been bullish since April, and I continue to be bullish. We got overbought there for a little bit, and so if you look at most on-chain indicators, it was starting to look pretty overbought. So I'm actually glad we got a correction. So the big thing to watch out for now is if Bitcoin hits new all-time highs, that in my opinion would be very bullish, and so that would kind of confirm the structural bullish trend. And so people can watch it now between it breaking down or going higher. So during this correction, the view I've been giving to my readers is that I think this is a correction within a larger bull market, and that depending on their level of conviction, they can either wait to confirm that it breaks above like 41, 42,000, and then that confirms the trend, or they can buy dips that occur. And so I've still been holding on to my Bitcoin, and I still think it has a very good 2021 ahead of it, most likely. Because that's a little bit different than gold in the sense that it's kind of gold's a mature asset, whereas Bitcoin's it's going through a period of adoption, and so it doesn't follow any one thing as closely as gold does. Like gold closely follows real yields, whereas Bitcoin is it kind of spends different 6-month periods kind of correlated to something else. It kind of changes what it's correlated to because it's really about the adoption cycle. It's really about how many people start to view it as money versus not. And so I still think, due to institutional demand and things like that, that's likely to have a good 2021 as long as there's no liquidity shock or something like that in a similar event that we saw back in March. So, I say in most scenarios, Bitcoin should do well, kind of like broader commodities.
Yeah, let me ask you one question that I forgot to ask you was about silver. People say silver is a poor man's gold and it often follows it and whatnot. Do you think that there is a possibility that silver breaks out from a purely commodities perspective? Right, there's a lot of conversation about supply. Just on Friday, I believe, or maybe it was on Monday, the JP Morgan SLV situation was like it was like 100 million ounces that they brought in one day, and there's only 760 million mined in a year. And so it's a little bit of a head scratcher. Do you think that there is a possibility for a separation like that, or do you think that silver will continue to more or less track gold?
I think there's absolutely a possibility for a separation. And I think, if one of the ways to look at it is that they could still kind of go in a similar direction, but at different magnitudes. And so, if you look at historically, whenever you, whenever you have real yields going up or down, because there's two variables, there's nominal yields and then there's inflation. And so if you look at, for example, the 2018 to 2020 period, we had real yields going down, but it wasn't because inflation was going up. It was because nominal yields, treasury yields, were falling from 3.25% all the way down to like 0.25% at the bottom. And so you had a 3% reduction in treasury yields. At the same time, you had a reduction in inflation, official inflation, but that was only a little bit. It went down from like say 2% to like at the bottom like 0.5% or 1%. And so by extension, real yields went down from being like positive 1% to negative 1%. And so that was very good for gold. But it wasn't very good for silver because that sort of disinflationary reduction in real yields, that tends to favor gold over silver. So if you look at the gold-silver ratio, gold tends to do better in that sort of kind of disinflationary falling real yields environment. On the other side of that, when you have a reflationary reduction in real yields, when you have inflation rising faster than nominal yields, that's when silver tends to do very well. And so, from that bottom we had in March, silver exploded a lot higher and faster than gold did in a relative sense. We had, the gold to silver ratio hit a multi-year peak, a multi-decade peak in that March 2020 timeframe, and has since kind of pulled back a little bit, but it's still pretty elevated. And so overall, I would expect silver to do somewhat better than gold in this somewhat more inflationary environment, with gold simply being a little bit held back due to nominal yields for now keeping up with inflation.
Where do you think gold, silver, and Bitcoin can go over the course of the decade? Are you in the camp of people that say, well, when this really takes off and this inflation really takes off, gold's going to 5,000, silver's going to 100, and Bitcoin's going to, 500,000. I mean, are you in these types of number camps? Where do you think it could be by 2025 or so?
I think when you look at the second half of the decade, I would expect all of those to be pretty high. And so if you think about, for example, $4,000 gold, that's only a doubling compared to, a little bit over a doubling, depending on what period you measure from. And so gold doubling in a 5 or 10 year period, I think that's totally on the table. And of course, there are scenarios that you can get a much higher figure than that. And so, it's partly going to depend on, how large these fiscal kind of actions are from different governments. And if you get yield curve controls, that the key variable, if you want to get those crazy numbers in, say, gold and silver that are really high, yield curve control is the type of thing that gets you there. And so, if you get that scenario, I am pretty bullish overall. And I think there's not that many routes that lead to a scenario where gold, silver, and Bitcoin together would all not be, at least like 2 out of 3 of them or so would be much north of here in a 5-year period. And that's one reason I like having a broad basket. And so, back during the 2018 to 2020 period, my gold stocks were outperforming my copper stocks by a ton. Whereas, in the 2020 period, I shifted a little bit more towards those industrial reflationary side. I still kept my gold stocks, so the copper stocks have been, outperforming the gold stocks. And so they kind of take turns, in a leadership role. And so I like having a pretty broad basket as we move forward in this whole, next 5 to 10 years. I think copper is probably going to do well. I think uranium is going to do well. I think gold and silver are going to do well. I think Bitcoin is going to do well. And I think they're going to kind of take turns doing well based partially on what things like real yields are doing.
So let's talk, you just mentioned uranium. So uranium uranium and silver where I have a lot of my portfolio, and they're two of the most common things we discuss on the channel. What do you think about the, uranium market's done very, very, very well. What are your expectations for it? I mean, there's a lot of discussion about how much supply is left, right? They say with financing and everything, the cost might be about $60 a pound. We're at about 30, and we're getting close to needing to bring more mines online. What do you think about that market and the potential of it?
Yeah, so it's one of those. It's a long-term play because that supply deficit takes a while to play out, and it's already starting to kind of show itself. Especially because we had some mine closings last year due to the virus and related things. And so I am pretty bullish on uranium with like a 5-year view. And the specific timing will in part depend on when utilities, kind of start covering their kind of forward demand. That's a little bit of a timing issue, so that you can be off by 6 or 12 months in that area. But as like a buy and hold investment, I'm very bullish on uranium. Looking out, from here to 2025, 2026, 2027, because as you point out, the production cost has to go up to 50, 60, dollars or more in order to get more mines in operation. And a lot of people kind of ask, like, the Europe's closing some of their nuclear plants. The United States is kind of stagnant. But I think a lot of people are missing the fact that most of the new demand for reactors is in Asia. You have China and India, South Korea, the Middle East. Those are the places that are really building new plants. And you have kind of Russia and China. They're kind of the main builders of plants even for these other countries. And so they provide kind of services to build them out for some countries. And so barring something like a nuclear disaster, and say the United States takes part of its fleet offline like Japan did, basically barring a tail risk like that, there's not that many scenarios that I can see where you don't have a notably higher uranium price in 5 years. And the exact path to get there, I think, will vary. I became bullish on it in October of 2020. So I had a premium report on that, and I covered why I'm bullish on uranium, and I have a long position as kind of an uncorrelated part of my portfolio.
So let me ask you then. I love what you said, and I'm with you on that. Now, to kind of wrap up, there's a lot of people right now in the world that are significantly behind on the rent. They're significantly behind on their mortgage. There's a lot of people that have lost their income. There's, I think I saw that Chapter 11, it was the highest initial opening in a year that we've had in a very long time. Oh, all in all, we're in a kind of chaotic situation. Nobody knows if there's going to be another big drawdown in the market. And it seems like one of the most important things that we can do right now is really prepare ourselves financially, because right now in a turbulent time, money does equal freedom. What do you think are the most important things for someone to be thinking about, considering, or personal philosophies you're implementing or have been implementing in your life to continue to prepare yourself financially?
Yeah, so I think diversification and self-sufficiency are pretty important to basically, have as much resources as you can, and have kind of diversification of those resources. And of course, resources refers to a variety of different things. And so, for example, if a household has two incomes, you want to have it as much as possible so that if one person were to lose their income, the other person, their income can cover their necessary expenses like their rent, their food, their utilities, things like that. And to kind of have the other income be more suitable for the optional expenses. And that's unfortunately, it's out of the reach of a lot of people, but everybody can kind of strive to get as close to that as possible. And so whether or not it's doing things like side hustles or just ways to generate more income, and also to kind of basically I like to do an idea of an expense audit. So people, instead of kind of like trying to pinch pennies in everything you do, just kind of evaluate everything you spend money on and say, what is important to me versus what's not important to me. And so for things that are important to you, if you can afford it, those are certainly places to invest money. Whereas, a lot of things we just kind of spend mindlessly and say, okay, what is kind of one or two kind of key decisions we can make to just kind of cut expenses in that area. And then apart from that, it's about being, diversified, having kind of, different bets in different areas without being over diversified, not investing in everything. But for example, if silver doesn't work out for the reason, then you have uranium. If uranium doesn't work out, you have silver. And so, for example, that's why I like a pretty broad set of commodity exposure. And then I also like seeing things like some foreign equities. And I even keep some cash on hand just because, we could have liquidity shocks. We could have all sorts of things that kind of open up, buying opportunities in the market, even if I think long term cash is not a great holding. And so that kind of diversified basket, while also trying to optimize income, diversifying it as much as possible while keeping expenses manageable. And it's a challenging thing because it is really hard for a lot of people in this environment. And the best we can do is just kind of do the best with what we have and try to figure out how we can kind of min max all of our different kind of variables we have in our unique situations.
So let me ask you, in conclusion, What's some of the most important philosophies that you have used to guide your business and your finances? You just discussed some of them, but is there any guiding philosophies or fundamental things that have really shaped your life that might be valuable for a listener?
I think, focusing on quality first in the long term really helps. And so, for example, when I started my business back in 2016, I didn't even try to make a profit the first year. And so the goal was just to build out content, to build out business, build out trust, respond to emails, just kind of focus on, all of the nonprofit things to build that foundation. So that when I eventually started to kind of build up a revenue, it's kind of like one of those things that's an overnight success that comes from several years of preparation and building a foundation. And so I think, that kind of applies to most things in life is they show that one of the best things you can have is delayed gratification, the ability to say, I want to focus on something now so that I can kind of reap the rewards, a couple years later. And, I think there's always kind of a sweet spot, right? Because some people fall into the trap where they always are thinking about the future, and then before they know it, they're old and they kind of missed out on a lot of the things. And so you don't want to be extreme in that regard, but you want to kind of just do kind of an audit once in a while, take a step back, have self-awareness, say, where do I want things to look like in 3 to 5 years? Not talking 10, 20 years, but where do I want to be in 3 to 5 years? And then kind of do things now that increase the probability of you being able to get there. And kind of plant those seeds that are hopefully kind of start turning into trees by that time. That's really how I approach most things. Is not with a super long term view or with like a super short term view, and really with that kind of 3 to 5 year view.
Do you think that the lack of our ability to to shy away from our instant gratification, do you think that is why one of the primary reasons there's so many of us in the world that are really struggling?
Well, I think that's a key thing with human nature in general. And different countries all have different reasons why people are struggling. Sometimes it's fiscal decisions by government, sometimes it's personal choices by people. But all we can control in the long run is ourselves. And so, I think, when people often have a kind of a misconception of what will make them happy. And so, if they're kind of, feeling lackluster in one area, they often think that spending or kind of consumption will fix that for them. Whereas, a lot of times it's kind of like doing high quality work or kind of, basically doing things that generate a state of flow in your life. And that those are sorts of things that kind of increase happiness for most people. And so kind of going back to basics and say, if I kind of nurture my relationships, if I get enough exercise, if I, just kind of focus on having a constructive 3 to 5 year view, that can kind of just inherently reduce people's kind of, instant gratification desires. Because instant gratification is often like a symptom of something else that feels incomplete for them. Whereas if you kind of get those foundations in order, it's like I find the easiest way to not want to spend is that I'm too interested in doing something like productive, because it's not like, that the ideal point is to get to a state where it's not really one or the other. It's like what you want to do is kind of produce something or things like that, and rather than kind of being based around consuming. And it's part about finding meaningful work, and that doesn't even have to be paid work. It just basically finding ways to contribute value to things that make you happy and make other people happy. And I think it's kind of that's why I approach things.
I love it. So let me ask you last question. I talk a lot on this channel, and I always try to ask guests about, I think more important than, for so many people, they get caught up in they need to buy gold and they need to buy Bitcoin, and it's this one investment. And in a lot of instances, they don't really even have that much capital for it to be something that helps them retire for the rest of their life. And I think one of the most important things, if not the most important thing, is a business and additional streams of income, especially in the world that we're moving into. And, you've successfully built a business, you've leveraged the internet, you have happy customers, and you've done a fantastic job. And I think there's a lot of people that are starting to wake up to the necessity of maybe trying to build an additional source of income, but maybe they never done it before. It's like a little scary too. How did you get over the fear of starting your business and maybe it not working out? and what's some of the most important things you learned throughout, your success in business?
I think one of the key things is to start small, but at least start. And so, one of the traps people fall into is they always want, it's kind of like they let the perfect be the enemy of the good. They think about it so much but they never actually take the step to do it. And so, for example, I had my first website back about a decade ago, and it was just kind of a small website. It was a successful website. It made money, but it never really was a giant thing, but it built experience. I learned how to do some basic search engine optimization. I learned how to improve my writing, right? Because I've always been more math and science oriented. My writing was always kind of mediocre, but if you write, 1,000 articles, you get a little bit better at writing. And so, it's not like I'm not a great writer, but I've certainly improved it over time just from doing it, just from getting it out there and kind of getting feedback and keep kind of iterating, going over, looking at stuff I wrote 2 years ago and being like, I got, like kind of improving there every year. And, so that first one was small. It wasn't like some life-changing thing, but it built up enough experience that when I did start, my real business, basically it was able to grow a lot quicker from that previous experience. And so that's, the first thing, as I would say, your first thing doesn't have to be this massive success. You can just start something and it can generate income, hopefully, and it can start to do something helpful for you. But then the main thing you get at first is experience. And that tells you, what can you do to grow that bigger, or what's another business you can start. And that overall just gives you more and more kind of that momentum that keeps building.
The late, the great Bob Marley says, if you don't start somewhere, you're never going to get nowhere. So I think that's an absolutely fantastic way to end. It was really interesting especially the last few minutes, to hear more about your business and finance philosophies. So for everyone listening, please hit the like button on either side. Give us a comment down below with the best thing you learned. Lyn, tell us where, is the best place for those that want to join you, either in your newsletter or whatnot. I'll put the links in the description for everyone, but just tell us.
Yeah, so I'm at lynalden.com. I have a free newsletter and I have free articles. I also have a low-cost research service, and I'm on Twitter at Lyn Alden Contact, where I share a lot of charts and things like that about finance and economics.
Okay, everyone, so we'll put the link right there down below. Thanks to our sponsor today, First Majestic Silver, and thank you for joining us and having some fun with us, Lyn.